What is open-ended and close-ended mutual fund? If you're new to stock market investing, you may have heard that mutual funds would be a good way for you to get started. That's actually good advice, but mutual funds have their own pitfalls to watch out for. Here are some of the things you need to know about the disadvantages of mutual fund investing. First, many people are under the impression that mutual funds have a lower risk than investing directly in stocks because they are managed by professional fund managers. That's not necessarily true, because the fund's performance will ultimately be determined by the experience and expertise of the fund manager. So if the fund manager is good at her job, the fund will do well. If the fund manager is inexperienced or just lacks talent, the fund could perform poorly. That means you still need to perform your own due diligence on the fund itself and on its manager. And you'll still need to monitor the fund's performance over time. It won't be something you can purchase and then ignore and still expect it to prosper. Next, you will still have to take responsibility for diversifying your portfolio. You can do this by choosing a fund that purchases stocks in a wide variety of sectors and is widely diversified across the market. Or you can invest in more than one fund if each fund specializes in a particular sector. But you will still have to become knowledgeable about investing in the stock market at some point in order to make good choices about diversification. Otherwise, you run the risk of over-diversifying and canceling out your profit, or under-diversifying and losing the risk-reducing characteristics that mutual funds can provide. Another disadvantage of mutual funds is the cost of the management fees. Typically, there will be fees assessed each time you buy and sell shares. In addition, there are usually yearly management fees to offset the cost of the built-in stock market research and the fund manager's salary. And there's one more disadvantage that most people don't think about. Mutual funds are usually marketed as being more liquid than owning individual stocks. Generally, it's easier and faster to draw cash out of a mutual fund than it is to trade a stock. But that liquidity comes at a cost to the yield of your investment. In order for the fund to have the liquid cash available for quick and easy withdrawals, the cash cannot be invested in additional stocks. So the cash liquidity of the mutual fund comes at the opportunity cost of investing in more stocks. Despite these drawbacks, mutual funds may be a good investment for you. Just be sure to investigate the issues listed in this article in order to make an informed decision.